my name's Nick Britton. I'm Research Director at the AIC, and today I'm joined by Seb Wallace, Head of Ventures at Triple Point, and we're going to talk about the Triple Point Venture VCT. So I'm looking forward to hearing all about the VCT.
I'm looking forward to telling you about it.
Absolutely. But first, a little bit about yourself, Seb. So tell us a bit about your background and career and how on earth you got into venture investing.
Yeah, it's a very good question, because actually, when I was thinking of going into venture, somebody said to me, anyone who's been in venture for a long time, they got in through the side window. And I always thought that's quite an interesting analogy. And then I look back and I look at how we did it at Triple Point and how I did it. And it was exactly like that. I started my career at Allen Overy as an M&A lawyer. And I'd previously had a events business that I'd sold. And I was not fully satisfied with that role. I'd previously run a business and I came into this very intense workplace, phenomenal intellectual talent in that building. But it just felt too removed from the reality of business. And then a few years into that, I co-founded a business called Further, which is now it's the market leading solution for fund administration in the tax efficient, particularly EIS space. And so I really got to understand the ins and outs of business, like being someone that runs one. And at the same time, I met Justin, who is a partner at Triple Point. And because I was talking to various people about, well, what would my next move be if I were to move out of law? And Justin actually said, well, Triple Point is looking at doing some venture capital investing, and we also want somebody with legal skills to help us with various bits we're doing internally. So I actually moved over to Triple Point at that point. And then about 6 months later, the ventures business was born. It was me and two other guys. We co-founded it together, and we went out to raise a VCT. We had a VCT in Triple Point already, the vehicle. In fact, Triple Point's got a long and rich history of VCTs. Our first ever product in 2004 was a VCT. And so as VCTs have evolved over time, we've had a product or proposition in that market. And so when the patient capital review happened, as you probably remember, that was where Triple Point decided to reassess what it was going to do with this vehicle. And we and our ventures business was what we started out with. We also did an EIS for a bit as well. We did that for about a year and a half before we started the VCT. We'd sort of running them in tandem. But then after the first fundraise, which finished in April 2019, we began investing, and that was the inception of the VCT, and we're now here in 2026.
Excellent. So you were bitten by the entrepreneurial bug early in life.
I kind of feel like you have to understand it in more ways than academics if you want to be a pragmatic investor, because the core of being a VC, I find, is not in the textbook. You can learn a financial skill set quite easily. It's often codified, whether it be the CFA or an advisor exam. It's not to say that they're bad exams. In fact, they're often some of the best exams to do if you want to be a professional services employee. But entrepreneurship is more of an apprenticeship skill set. And having done it or experienced it in some way allows you to understand that 80% of what's happening is actually grey area, and growth is not up and to the right, despite what people think. And actually being on a journey with somebody and understanding that a lot of the time, you're not quite sure, if you're honest, what the next 5 steps are. You might have step 2 and maybe step 1 and 2, but you might have step 2 and 4 at some point. But you still need 1 and you need 3. And that iteration, it requires a bit of luck, it requires timing, and it requires skill. And all 3 of those things are important. I think in order, it's timing first by quite a distance. If you have a product in the wrong market at the wrong time, it won't work. And then, of course, skill is critically important, because with timing, you need to absolutely be able to execute. Luck, I think, is a factor of those first 2. If you've got those 2, you'll probably find some luck. The question is not, the parallel I give is, if you are sowing seeds as an entrepreneur, you're working hard, you're continuing to develop, then the question is not, is something going to develop in your little patch? the question is it going to be an oak tree or is it going to be a small plant? And that's the luck element. But like actually having an outcome and having something happen and work is that hard work, and also like building teams. So having gone through that, you have like a level of empathy for the founder. And also I'd probably say, like, if it is a craft, like it's a love for the craft, like the love for seeing VC and businesses grow. And like our focus is to be seed stage investors. Seed is a blurry word nowadays. Seed in our mind is a business that's, you know, not mature. It's normally sub 20 people, sub 25 people, could be way less. It can be 2 or 3 people. We have one company that has 3 people and is hit 100K MRR recently. You know, so you can have small teams, but they tend to be under 25 people. Revenues sub circa 2 mil at the point we're investing, mostly less than 1 mil, and actually often little to none.
Okay, so let's talk a bit about that and the venture VCT, because you used the word seed. You're investing in businesses before they have certainly profits, I'd imagine, sometimes even revenues.
Definitely profits. We sometimes exit them before they have profits, Nick.
Okay, that's quite a skill.
Yeah.
So isn't that a bit risky? I mean, how do you mitigate the risk of investing in those very early stage businesses?
Yeah, I mean, if you look at the VCT market overall, like we are definitely the VCT that invests at the earliest stage consistently. Like there are VCTs that invest across the board in different stages. There are some that focus at the late stage. In fact, several that focus at the late stage. But at that very earliest stage, we're pretty much the only VCT that's developed of reasonable size that is focused there. Of course, each individual deal has a higher percentage chance of failing. Like roughly speaking, 65% of deals at the seed or pre-seed stage will not work out in some way, shape or form. Doesn't necessarily mean a 0, but it might not be a return of the money.
Is that a figure from your investments?
So that's the market more generally. Yeah. Okay, our numbers are around 10% at the moment, 11%, which is lower. You know, actually over time we expect to creep up. When you take risk, you accept and expect failure. The key thing we do to mitigate the risk of going earlier and having that slightly higher failure rate on an individual company basis is that we invest in many more companies.
Right.
Now, a purist might say, well, hold on a second, you're investing early, you want higher returns, you've taken higher risk. And absolutely that is like a fair objective. But in a VCT, the objectives of the clients tend to be that I would like a dividend, I would like consistent, stable, ideally growing NAVs. But that management of capital and delivery of dividend, which is tax-free, is very important for planning. And it's a very intelligent policy that was built by the governments, successive governments over 30 years, because it funnels money into innovative companies, because obviously we invest in companies that are very early stage startups, but it funnels money from people who are not of the traditional risk profile to be investing direct. And we invest in many more companies. Diversification is the key play. We are at this stage of recording with the most diversified per £1 million of AUM in the VCT market in terms of number of companies to AUM. Very deliberate. It's the great leveler. It lowers risk, it lowers reward. The people who we talked about who would want the reward, you know, they would be not looking at a VCT. But the people who are looking to expose themselves to this and have the income, our strategy is effectively going early, individually higher risk, more companies, mitigates that risk, it sort of flattens out at a similar sort of overall portfolio construction, risk tolerance, return expectation as a later stage investor who does fewer deals.
Right. And it's a remarkable vehicle, VCT.
I do think that
it's a unique vehicle.
I also think VCTs are very misunderstood. I think that there are a whole array, a very wide array of investors within VCTs. VCT is a vehicle. And if somebody were to say, an investor in private equity and an investor in venture, the traditional vehicle they use is a limited partnership. We don't say, limited partnership investors, because they could be very different strategies within the same vehicle. The same thing applies to VCTs. People often say, VCTs. Well, VCTs, now more than ever, are very diversified. Yes, okay, you have some constraints. In fact, constraints that have recently been sort of loosened slightly, which is a good thing. But But we have people like us who are very, very pure play venture right at the beginning. You know, we're investing in companies. We're not charging them any fees. We're like right there at the beginning with their idea, helping them build that 0 to 1, helping them build and employ their first 5, 10, 15 people while their product's coming into fruition, right at the beginning, almost apprenticeship skill set, as I mentioned. But then you have other VCTs that will invest at businesses that have £1.5, £2 million of revenue, relatively proven track records, established teams. They might be around for longer. They might be in different regions of the UK, like very different. They might have fee structures that are different to ours because they're closer to like private equity growth, still growth, and very much like absolute engine of the economy, but very different to our style, which is that much closer to like red-blooded, startup capitalism right at the beginning. I think VCT is a fascinating vehicle because they enable investors to have access to those different types of strategy. I think now more than ever, people should be asking what strategy VCTs.
Sure. I mean, this seems like a good argument for looking at more than one VCT and more than one VCT manager. Obviously, we're here to talk about Triple Point.
But I would never ignore the others. Yeah.
And should advisors look across? Should they think about diversification across VCTs as well as within VCTs?
I personally would never put all my eggs in one basket. I think if you don't necessarily have to be highly diversified. You don't have to be across like 15, 20 VCTs. In fact, I think the old Warren Buffett adage and Charlie Munger was that you don't diversify if you really know what you're focused on.
Yeah.
But actually, I do think in VCTs it makes a lot of sense to diversify. You have different revenue streams, different dividend streams coming from different VCTs on different cadences, different strategies delivering different objectives. Like I do think that being diversified across VCTs is much more intelligent. It also lowers the risk. Like you have seen in a market that takes risk, you have seen some people lose money in the last few years in some products. That's totally, in my view, healthy. Like that you're investing in a product that has risk is a reason why the government provide a tax relief, and our product sits on the as an overall VCT product sits on a riskier end of the spectrum. And you need to be diversified in managers so that you can mitigate some of the ups and downs. There might be years where our VCT is the best, and there might be years where another VCT is the best, and like that's absolutely normal. And to be honest, I think anybody investing in under 3 is probably over-concentrated.
Yeah, no, fair point. So let's talk about Triple Point Venture VCT and the kinds of companies you've invested in. You've talked about how you invest in early stage companies and explained why that is. But you're also investing in B2B companies, aren't you? And there's a whole universe of companies out there. You could be investing in consumer brands, retail, but you're not doing that. You're focused on B2B. So why is that?
I think when people think about successes in the startup world, they often think about if you talk to the normal person, they often think about consumer first. They think about the Apples of the world. They think about the Microsofts, or at least they think of the Microsoft in the home rather than in business. But actually, if you look consistently over time, B2B business models are much more stable, much less variation in them over time in terms of revenue profile. There are playbooks that B2B businesses can use for sales, for management, for customer success. When you look at B2B coming to its maturity point as an investment, which is obviously where you look to exit deals, there is pretty consistently many, many more exits in B2B than there is consumer, roughly 2.2 times almost every year. And the reason for that is it's obviously that there's a lot of opportunity in the B2B market because B2B businesses often grow by bolting on other businesses. Like what large company do you know today that doesn't have a corporate development team, which is basically an M&A team in organic growth? But really the main interesting factor there is that B2B is the larger part of the economy. If you look at how most people are employed, 80+% of the market is employed in the private market, not in, of course, in the public sector, but in the private market is working in B2B businesses, because the consumer-led economy, whilst it's all that we feel as individuals, it's this layer, this iceberg on the top. And all of those consumer businesses, they'll have a whole host of products they use, and those businesses have products they use, and it creates this like big interconnected mesh. And by investing in B2B, you get access to, think of it like the iceberg beneath the surface, that you get access to a much larger pool of companies what happens when you have a much larger pool of companies? Well, there's more diversity. There's more opportunity for things to happen. Like, why do big economies do better than small ones? It's not because the individuals are necessarily higher talent density. It's just because with more variety and more opportunity, more things come up. There's more potential for success.
The network effect.
The network effects, the cluster effects of like different people in different areas. And the same, and B2B is almost like, if you look at the economy, the modern economy, you can almost say, well, if that is saying I'm investing in most things, I think consumer can be a very interesting place to invest. It's a home run place often. You will invest in consumer, and if something really takes off, it can take off very fast and very efficiently. But often you're really focused and really slogging to make it work. It's not to say the most enduring businesses in the world have been consumer businesses. The Coca-Colas of the world.
I suppose that's the reason why it's so hard to launch new ones.
Yeah,
because you've got such giants out.
You do have big giants, but there is always rejuvenation in the economy. But when there are a handful of very large dominant players in B2C consumer businesses, the rejuvenation, your chance of hitting the shot on goal there is smaller. And so B2B, when you have capital to deploy, is just a wider, more varied market. And ultimately, exits are what drive like the health of the economy in venture capital. Exits are what drive the health of the VC asset class. And when you have more of those happening in B2B, you have more opportunity to find those realizations. So it's very important, I think, that there are people investing in consumer businesses. Otherwise, we wouldn't have Amazon that we all use, I'm pretty sure, compulsively. But yeah, in our view, B2B is an area which is more attractive for investing based on the variety.
So you're investing in that base of the iceberg. It sounds like you have an awful lot of companies in your opportunity set, a lot of companies you could go after within to B2B, even within the confines of the VCT rules. So let's get into the nitty gritty of how on earth you pick these companies to invest in, because I'm sure you see an awful lot more than you actually end up investing in.
Yeah. I think the issue in the venture capital, like the issue in the VC asset class overall, is it an issue? I guess I'd say the fundamental characteristic of VC in an economy like the UK, which despite what people may say, people have their concerns and criticisms, as a culture, we're very entrepreneurial. We were the birthplace of liberal capitalism in the modern successful word. Obviously, America took it to another level, but we are a very entrepreneurial place. You can start a company for 12, 14 quid on Company's House. And being here and having that sort of mindset means that you receive a lot of interesting deals that would never really receive venture capital funding. They might be viable businesses, but venture capital funded businesses have a particular characteristic. They're looking for much higher than average growth, and they tend to be looking to be very dominant in their particular markets. People are slogging very hard as founders. It's not necessarily something that people talk about a huge amount, although in the Twitter sphere it is now glamorized, but there is no 9 to 5 in doing VC. If you're taking venture capital money, you're probably going to work harder than you've ever worked before in your life. And because you want to, not because you have to. It's like part of the journey in deciding to do that is that you want to have that outcome for yourself. And what that means is when we're looking at these companies, many that you may have the opportunity to invest into will just not meet that bar. And it may be mutual. It's like founders who come to realize the type of business they want isn't a venture backable business.
Yeah.
But it mostly comes down to just two things. You have the founder, and which is founders, the team, the core team, the ability to storytell, the ability to understand the market in which you're operating is absolutely immovable. It is requirement to do well. I read something that was Nick at Revolut had an anecdote. He said, well, what do I want to achieve? He said, well, I want to beat Barclays near the beginning. Or it was a beat Barclays or JP Morgan, one of the large banks. Like outlandish at the beginning. And pretty much all founders have that outsized motivation to perform. So the first thing we're doing is we're understanding what makes the founder tick, because to want to go on that journey, you do have to be a little bit unhinged, and that's okay. Like, that's what leads people to this. It's not for everyone. Secondly, when we're looking at the founders, we're also trying to understand the expertise they have. So you can be, in my experience, one of two types of founder. You can either be a founder that has experience in the domain in which you're building. Think it's somebody who's building investment trust software and has worked in investment trust for a long time. Or you can be a polymath. You can be somebody who is just able to grasp in incredibly fast, complicated concepts and see opportunity where others don't see it. Now, the second type of founder is very rare. Like, probably typified by people like Elon Musk. But there's lots of them. Alex Chesterman in the UK. There's various people who've done this several times. But that first type, that domain expertise founder, is certainly the easiest one to hook onto. That they understand what they're doing.
So I was going to ask, actually, I'm sorry to interrupt your flow, but no. I'm interested in this idea of unreasonable people, and we've talked about it before. You mentioned Elon Musk. As a venture investor in these people's businesses, without a controlling stake, how on earth do you go about interacting with these people?
I think the first thing that people outside of VC don't realize when they come in is that we are brought up in the classroom to be good employees, to follow rules, to not question too much, to deliver on what we need to do around us. Now, the reality is it's almost like a matrix. And to be a really good founder, you have to take the red pill. You have to start to be that annoying, intolerant person who is questioning everything. Doesn't mean that you're annoying on a personal level necessarily. In fact, many of them are very charming people. But you do have to go to first principles on basically everything you're seeing around you, because that's the way you see the commercial opportunity. It's the Ford. Or was it? He said, if I asked people what they wanted, I'd have given them a faster horse. And I do think that as a founder, you can be somewhat difficult as long as you are driven, determined, and balanced in business, which are different things. I do think that most people, they never have to engage with the pointy end of business because they're in larger organizations, there's politics, there's structure, there's a sense of if I do the jobs I'm given, which are cascaded from high down, that I will deliver for the business's objectives, and they're not wrong, that is true. But when you go into the startup world, you go into the unstructured. And the people who create order in the disorder are people who, if we were to reference them, say most have worked in another job, they've come out of university and gone and worked in a major startup or gone and worked in a bank or a law firm. And if you were to reference them, you'll regularly get feedback very intelligent person, fiercely intelligent, very difficult individual. Things like that. And that's a good thing. And the funny thing is what we're told to be, nice people in life, that's not at all what we look for in a founder. It's not to say you can't be that, you absolutely can be. But you are looking for an intolerance. You don't necessarily have to be intolerable, but the founder has to have an intolerance. And at least any good founder has to have that. And we become very nuanced in that assessment of people, very, I guess you could say, tolerant of that intolerance. But that's the first thing, is looking at that personal characteristic combined with domain expertise.
But can these people, can they take input from you? Because, you must have a lot of expertise you can offer these people to help in their businesses. Can they take that on board?
I think that the best founders, the generalist expertise that a VC can deliver them, even if the most technical VC will be a VC who has already built a product in the market of a business they're investing in. You can't get a better VC than that on paper because they understand the market, the dynamics, the way to build the business, etc. But even that experience is different from now. If you've been a VC 5 years ago, 10 years ago to today, the technology is even different. You might not notice it, but under the hood, it's different. And the competitive dynamics are different. I do think it's very important to know, yes, you are a generalist. You're somebody who is more like a baseline reset for the founder. It's like come out of the woods and sort of sit in the helicopter looking onto the forest and let's just discuss a little bit about where you're going with the business and reset and recalibrate the longer term objectives, because good founders are very focused on like, step by step to the top. But I don't think a good founder needs a VC to succeed. And actually, I would argue it's the opposite, that if somebody thinks they need a VC to succeed, they need the capital, I'm talking about the VC itself, then I think they're probably not the best founder. The best founder tends to be finding their own way. If your livelihood is around your business succeeding, then you will obsess over your problem every minute of every day, including the weekends, because you want to succeed. A VC will just never be at that same level of integration with you, because they have a portfolio, even if they're a great VC, even if they've got more than, unless they only have one investment and you're it, and they're dedicated to you, there will be that portfolio effect, which means they're one step removed. And I think it's very important to understand that VCs can offer advice, but realistically, it's of limited use to the best founders. And my belief is that you're more there to give them the capital, to stress test them, to recalibrate them, to allow them to take a bit of a time to breathe, and obviously support them where you can. I mean, my experience as a founder was commercial introductions were the most important thing, because that's what you're always fighting for, right? But actually the core of running your business as a VC, yeah, you might have expertise, but is it relevant to that founder at that point? It's like a diagram, a Venn diagram, where it only overlaps very slightly at any point with any one founder.
Does it become more hands-on when it comes to the exits?
It can do. It depends on the type of exit and who's like wanting the exit to happen. We certainly do help with like exit modeling and waterfall modeling for the founders, because they often, there's lots of different structures that can be used for exiting businesses, whether that's like cash or shares, and different structure within shares. And what type of share are you going to get in a new business? Or getting cash, is there an escrow? Is there an earn-out? Is the earn-out certain? Is it set by the deadline? It's like a milestone. It's like all of this stuff we help founders with for sure, because it obviously is something we see a fair amount of. But even then, the founder will be driving. If you think about it, you've put your sweat, blood and tears into a business for the last decade, and you're now selling it. Do you think you're going to be absorbed with the sale? Hell yeah. So we do help, but they're often well on top of it themselves as well.
So Seb, can you give an example of a company you've backed in the last 12 months, say, that really excites you?
Yeah, I think a business that we've seen really come on leaps and bounds is Nori, which is restaurant management systems. And realistically, restaurants and hospitality, they've had a torrid time. If you look at the UK markets, you see at the time of recording, we're hearing about rates about to increase, and you've got, Labour MPs banned from pubs. I understand there might be a U-turn going on soon, but hospitality is feeling the pinch. You've never needed, it's always been an industry where margins were important because they were razor thin, but it's never been more important than now. And Nori have grown phenomenally. We invested in them at seed, and they've subsequently gone on, raised 2 funding rounds, one from XL, which is arguably one of the best VCs in the world, certainly top 5. And Kinnevik as well as a follow-on funding round, Series B, and they continue to go from strength to strength, just dominating that market. Interestingly, Connor, one of the founders, Connor really typifies what I was talking about domain expertise. He himself had a successful chain of restaurants before he started this business, so he can walk the walk and talk the talk. When he's talking to restaurant managers, restaurant owners, there's large chains they work with as well. Like he's been there. And that does help with the sale. It helps with bridging the initial credibility gap. Because as a founder, you are often at the beginning selling a product that doesn't have a huge amount of like testing to it. It's not being road tested. People aren't buying the product. They're actually really buying you. And so your ability to say, well, I've been there and done this and I've done this and that because I've done those 5 things, and I know you have done those 5 things and had these problems. I know that this product will solve this for you. That really helps bridge the gap. Of course, in the long run, the product ends up starting to speak for itself. And I just think he's just done a great job on that, with that business, and just the way that he's gone from those domain expertise beginnings into like being able to scale it up.
Well, it sounds like a very interesting business. Obviously, not every company is going to be successful.
No.
It's interesting to talk about, how we deal with failure as well and what we learn from it. I mean, can you talk about an investment that perhaps didn't go to plan?
I mean, the reality of VC is there are many more that you can talk about that didn't go to plan than did. And to be honest, the big regret with that is often that the founders, you see them send that email, I've decided that this isn't going to work. Often email, by the way, they might tell you, but email is it's like articulating it as having happened. It's their what would you call it? The email is their catharsis in some ways, even if they tell you that email is the catharsis. And one business we could look at that has experienced this was a business called Nook. It got bought by Modular, but as a business, it faced a really tough time. The founders were very dogged. It was doing effectively automated FX, but their product, when they launched it, it ended up in the market, and soon after it entered the market, they started having competition from the banks, who obviously have significantly more leverage in a product which previously they were effectively competing with, but then they realized, hold on, we're not going to have someone else come in on our turf. We're just going to start to loss lead a bit more. And it made it very tough, not just for Nook, but Nook had a couple of competitors. The market shifted pretty fundamentally. And in those situations, even if you're a tenacious founding team and wider team, it's quite difficult to fight. I said timing is the most important thing, then team, then obviously a bit of luck. But in that situation, the timing ended up being what didn't make it succeed. I think when you see a business that's not succeeding as a VC, you accept that, that. The questions you ask are more, if I were making the investment again, would I have seen that outcome? Should I have seen that outcome at that point? And that's where team analysis is really important, because if a team doesn't go hard enough, doesn't push hard enough, doesn't focus hard enough, you could always have seen that near the beginning. But market changes are not always visible, particularly when they're regulatory, like when there's reg-focused changes. Like that really is out of the blue. And you hear about many amazing, great businesses that got very close to problems because of one or two changes in the market. I don't know whether you know, but Amazon, I believe it was $400 million debt facility they were going to take, and they did take it, but they were wavering on taking it. And very soon after taking it, maybe even days or weeks, there was the .com crash, and that facility got them through. It's like small decisions like that. You do need that timing, and obviously in Nook's case, it wasn't there. And to be honest, that example, I could substitute that name for several companies. It's often to do with market timing. The other reason, if it's not timing, is adoption. It's things that we had another business called Constructly that was selling software to construction teams. But the reality is that a lot of that market enjoys working artisanally, enjoys doing things manually. And yes, okay, if you can automate things, they're working with people like Berkeley Homes, like you can automate things that sounds good on paper, but you do have to have people using the product. Obviously, knowledge workers in businesses with computers, they're given the next piece of software. Well, they're already trained behavior to use the software. But in that case, it was more difficult, it was adoption. And that sort of situation, people take a punt, they try and change the world. In theory, it can be changed, but are you going to be the time? And what normally in situations where that happens, you have 5 or 6 iterations of software, which grinds down the industry. And then by the 7th, they're like, okay, I think I'm ready to adopt some software for this particular need. And so that's a timing issue again.
Yeah. I guess we should talk about AI.
Yeah.
I'm sure a lot of financial advisors will be talking about this with their clients. Is that something that your business is asked of directly tapping into?
Yeah. I have a mixed view on AI. AI is absolutely, for anybody who's not using it, like going to leave people behind if you don't understand how to use it. In its chat format, which ChatGPT is probably most famous for, but there are several others like Perplexity, etc. And they're certainly phenomenally useful. I mean, I use ChatGPT every day. Like the Christmas break, which obviously we're recording just after, I spent one of my days going deep into underfloor heating schematics with ChatGPT in a way that it would just have taken 5 times as long on Google. There is huge efficiency to be had with AI. But I don't necessarily think every product's prime mode of solution is AI. And I think at the moment, the industry as a whole, VC, is getting very energized by the idea that AI is like the product that can solve everything in some form. I do think that as AI widens its abilities, there will be some really interesting opportunities. But as where LLMs are today and what they can do, for those who've used agentic forms of AI, it's very rudimentary still. And to the point around timing that we talked about, timing being so important for a business to succeed, there is a risk that in creating your agentic AI business today, that the models, the base foundational models, may not be good enough for you as a business to succeed. But maybe the person who does what you're doing in 3 years' time will succeed. And so I do think we have to be very careful about where AI is being used, because there's absolutely huge opportunity and will continue to be huge opportunity. But different uses of it, applications of it in different markets come with different timelines. And I think there needs to be perhaps a bit more nuance around that in investing. And so the majority of the businesses we invest in have a component of AI, or, in some cases are pure AI businesses. I do think a component of AI in everything is sort of needed, even at the basic level of, helping your customers use the product can be done through a chatbot. But these sort of core AI first businesses, I think you really have to assess, is AI in its current or potentially 1 to 2, 3 year form modally the right solution for the problem they're tackling.
So let's talk a bit about the UK economy. Obviously, when people think about VCTs, they are thinking about the UK economy, albeit some of them are selling or seeking to sell overseas. There's been a lot of doom and gloom about it, really, hasn't there?
Yeah.
How do you feel about that? What impact is it having on your portfolio companies?
I think that's a very important question. And I don't think in my working life, there have been 2 budgets that have been more trailed with policy announcements than the first 2 Labour budgets. I think the general consensus of the government today in the sort of private sector is that their policies are not quite chiming with the rhetoric, with we want growth, but the policies sort of being restrained by more political, expeditious reasons. And that is impacting. There's no denying that is impacting sentiment. What's interesting, though, is that sentiment and data are 2 different things. And sentiment, I would say, in the UK is quite poor at the moment. And people don't like higher taxes and Labour, and there is concern. But when it comes to running and starting a business, your 1 to 5 year view of politics is somewhat irrelevant because you're starting business for a bigger reason. But 2, you are in this position where the data is showing that the consumer is saving more than they've historically saved, that incomes are up annually more than they have been in the last 5, 6, 7 years on a percentage point basis, that consumer debt is down. The reason I talk about the consumer is that the consumer is such a major component of the UK economy, and B2B businesses, the contact point with the economy is the consumer, and it all feeds back into B2B. And actually, the data points to a relatively healthy underlying economy that's dogged by poor sentiment, which is affecting people's behavior. And I do wonder to what extent this doom and gloom will probably not come to pass, because at the end of the day, when the guns are pointing at you, you behave based on what you've got in front of you, not based on how you feel. And the reality is that what people have in front of them is better than what people think, or at least are talking about at dinner parties. The UK is really a fascinating place when it comes to starting a business, because our weakness is that we're a creche for businesses. We're a 70 million person economy. We're now not part of the EU, which means we're a reasonably mid-sized economy. but we have an absolutely amazing culture when it comes to starting businesses outside of America and China, but like China's its own little beast. Outside of America, we're the number one place for venture capital. We are one of the most enterprising, easiest places to do business. But generally speaking, on an international stage, we're in a reasonably good place still. Also, our businesses, they grow, they scale, and they tend to expand abroad because of the fact we're only a 70 million person economy. Where do they expand to? Well, by and large, they expand to the US. And so in our portfolio, it's not just about how's the UK economy doing. It's actually how's the UK and America and Europe's economy generally doing. Because if I look at our top portfolio holdings by like percentage of NAV, all of them have some international exposure selling. And the majority of them, I mean, like if I took the top 5, 4 of 5 sell in the US and are increasingly dominantly selling in the US. So actually, the UK economic position is more important for us at inception stage, at like investment stage rather than portfolio stage. And the core fundamentals there still are good. Like if you look at starting a business, normally a good business has a core group of initial customers who are exceptionally passionate about the product. They really need it. You kind of need that as a good business because that's the springboard from which you can grow. If you don't have a strong springboard at the beginning, it's very difficult to gain the momentum, the exit velocity to continue going. And so that tends to exist whatever the economy is doing, unless of course, unless of course you're a banking software selling in 2008. If you are specifically at the focus of a problem, then of course there's an issue. But by and large, if you're there focused selling in a general economy that's got it's got malaise but no specific concern that like impacts you, then you will tend to do fine. So I do think like we do have to admit that the sentiment is not at its strongest, but sentiment, data, where we invest, very nuanced and actually very different. And we have not seen any slower growth in our companies because of the UK's economic situation, which I think is the most important tell when you're looking at the health of the portfolio.
Okay, well, that's good news.
Yeah.
I mean, you talked about the economic situation maybe having more impact on the opportunities you're seeing than the existing portfolio companies. So I mean, how would you rate the sort of opportunity set that you're seeing at the moment compared to, say, 2 years ago or 3
I
years
actually
ago?
think it's much higher and much healthier than it has been. And the reason for that is nothing to do with the colour of the government in the UK. It's to do with the fact that interest rates have gone up. And with interest rates going up, the cost of capital grows. And that means that effectively it tightens what people have to do. To be in business today, you have to be a tighter operator than you were 5 years ago. And that means that the people who are choosing to run businesses today are going and running the gauntlet to some extent, much more than they had to in 2020 or 2021, and which will be looked back at as historically very frothy periods. So today I'm actually feeling quite happy about the type of businesses we're seeing. The second thing is I mentioned that the consumer is reasonably healthy on average. The consumer being healthy is a key prerequisite to someone starting a business generally, because you don't start a business when you have no money in the bank at all. I mean, you can, but mostly you start a business when you've got a little bit of money, a little bit of personal runway. You might have 6 to 12, maybe 24 months of money. You're burning that money, starting your business before it grows. So the healthier the consumer is, the more likely they are to take the step to go and build their own business, forget the sentiment in the UK. And then combining that with the fact that capital's a little bit more expensive now and that people are being a little bit more careful and running their businesses a little bit more tightly, I'd say this is a great, quite happy and equilibrium that we're in today. I feel much happier being an investor today than I did in 2021, when I frankly felt that it was a year of panic amongst investors trying to deploy money into deals. And looking back, that panic never translates into good outcomes for anybody.
Okay, so a great time to invest, perhaps, in terms of opportunities. I mean, the flip side of that perhaps is not a great time to exit. Would that be the case?
I think, yeah, like exits have they faced a pretty large lull. I think if you look at data today, exits are recovering from where they were last year, which was really the bigger low, and they were progressively going lower. They're now starting to recover. The issue is that if you look at the per pound invested exits, so not just how many exits, but amount of money invested in private assets generally, we are at historical lows. It's actually where I think VCTs are a particularly interesting product for investors, because it's a vehicle in which you are given liquidity through the cash reserves of the fund, and the fund holds back cash reserves specifically for that liquidity. It fundraises and pays dividends, and that's one of the reasons why we have the cash reserves, but it enables liquidity where there's no exits. As long as there are annual fundraisers, which there have been ever since they began, and the reason there are annual fundraisers is because there are annual tax liabilities. So there will be annual fundraisers as long as there are annual tax liabilities. And I don't know about you, Nick, but I don't think annual tax liabilities are going to disappear. And so effectively, these products enable you to be able to hold on to assets for longer as an investor, as me as an investor, not as an investor in the fund, enable us to hold on to assets until the right time. We are not suffering from what a limited partnership fund may suffer from, which is that you have a fund life. In my stage of investing, it's typically 10 plus 1 plus 1, which is up to 12 years. So it's 10 with 2 years of additional if you can get the consent. 12 years, you get to that 12-year mark, you are divesting in specie, or you are divesting in cash the assets of the fund, or you're rolling it over into another vehicle. Like, we don't have that same constraint. Of course, we want more exits in the wider market because it's good for the health of the overall economy. It's good for the health of the overall asset class. But VCTs are slightly insulated from that wider issue. But absolutely, there has been a slowdown in exits across the market. Although I should say that we do have a couple of businesses that have received quite a lot of interest recently.
Excellent. Let's talk about the last budget. As the old comedians used to say, there was good news and bad news for VCTs, wasn't there?
Yeah.
The good news was perhaps more anticipated. There was an increase in the amount of money you can invest in a business per year and over its lifetime.
Yeah.
And there was also an increase in the size of businesses that you can invest in, but really just to catch up with those limits having not changed for over a decade alongside inflation. So that sounds, let's talk about the good news first.
Yeah.
That sounds like good news for you.
Yeah, I mean, increasing the net assets of a company and increasing the total amount of money they could receive is absolutely a good thing. We had £6 million of deployable opportunity in our portfolio last year we could not do because they had reached the cap of the amount of VCT and EIS money that they've received. So removing that cap, which is not what they've done, but obviously doubling it is as close to that as possible. By increasing that cap, you've enabled us to be able to invest in opportunities like that, which you exactly as a founder VC, you want to do that. You want to be backing the teams that are doing well. And we were prohibited from doing that because of the rules that, as you say, were just eroded by inflation ultimately. So improving that is a big plus. It came with a kicker, though, which of course was the income tax relief going from 30 to 20%. That is significant. That is significant. And this year we are seeing increased interest because obviously the rule change comes in April. Yeah. And we are being very disciplined with that, but we are being very focused, and it's not unexpected. Next year, it remains to be seen what it will be like. But I don't think anybody can say reducing the relief from 30 to 20 will be a net positive thing next year for the overall fundraising in the market. Will it calibrate over time? Yes. There are lots of things that have happened in VCTs over the last 20 years. We've changed these reliefs up and down several times. And I think that seeing what the ongoing fundraise levels will be for VCTs will help the government decide whether or not this is the right rate, because their assumption was it would not reduce fundraising materially. The thing that I think people historically have not had to look at when they look at the rates changing over time in previous years, they say, oh, well, the last time it went down like this, the market dropped 65% the following year. We are in a period, though, where there are significant tailwinds for VCTs, mainly because of pension restrictions. You have the annual allowance. You now have admittedly, it's a couple of years away, but you have the decision to reduce the pension contributions you can make through your gross income, which is obviously going to put pressure on where does that money then go. So these different opportunities have manifested in VCT being the solution. Effectively, it's a way of bolstering your pension income and mitigating some of the tax impact of not being able to invest in your pension. And they didn't exist in the same way in mid-2000s as they do today.
Yeah, I mean, I remember when the annual allowance taper was introduced, and I think the latter half of the last decade, it made a big difference to VCT fundraising. It really increased it.
Massively. And I think that these tailwinds exist. We just don't know. With these tailwinds, plus a reduction from 30 to 20, we don't know. Will it be 65% lower or will it be less because of all these tailwinds as well? I do think that 30% was the right level. It wasn't the higher rate tax band. It wasn't the basic rate. It was for most VCT investors who are either higher or additional rate taxpayers. It was not a full recuperation of their money. I do think it was a fair rate considering the risk of the underlying assets in VCTs, even though they are mitigated. And certainly if you look at other products in the market, there have been products that have lost material money, and that's the point of these reliefs. But we are where we are, and I do think that there are significant tailwinds to VCTs.
I suppose it's important to say that the 30% upfront income tax relief lasts until, 5th of April, 2026.
Yeah.
And also, you've got the tax-free dividends. There's no change to that.
No change to that.
Which has probably been, over time, the more important relief. People always focus on the upfront relief, don't they? But actually, if you've held VCTs for a long time, the tax-free dividends might be
100%. And obviously, that one-off relief, if you're just continuing to hold, it's going to diminish the percentage of the total relief. Yeah. So, yeah, exactly. And that's that tax-free income is very important for a lot of investors because of the age they are, their demographic, their planning. And so that's a very important element. That initial relief is a useful kicker and certainly an incentive, but it's not be all and end all.
Can we go back to talking about the increase in the investment limits and what's called the gross asset test, so the size of business that you can invest in? Because I think people will focus less on that, won't they, than the tax relief change. I mean, what do you think will be the effect of the increase in investment limits and gross assets test on individual investors in your VCT?
I don't think that it will necessarily affect our investors. And the reason I don't think it'll affect our investors is because we invest at the very earliest stage. But what it will do is enable the businesses that are performing well to continue to receive money, which means that we'll have a larger stake in those businesses if they were to then exit and continue to progress, which is obviously good for our investors. I think that it has more of an impact on the managers themselves, because what you've had is specialists like us who are investing at the very earliest stage who were comfortable with the previous rules because we invest at the earliest stage and we only get hamstrung later on in our portfolio. But the investors that are investing at the later stage, in the VCT investors that invest at growth stage, they were getting significantly impaired by basically not being able to invest in companies that were in their core mandate because of inflation. And so by widening this, you've sort of enabled them to play where they are. And I think that's very healthy. Some of them fund our businesses later on as they progress. Many of our businesses receive money, the majority receive money from the private limited partnership, venture capital, wider market, both here and in the US. But I do think that overall enabling those later stage VCTs to play in their space for more comfortably is better for the vibrancy of the market. And that obviously benefits everyone. I don't think it's necessarily something that our investors specifically benefit from per se. I think it's just a wider health point.
So Seb, this has been a fascinating conversation.
Yeah.
And just to kind of round it off, I'm going to ask you what's probably the most challenging question. You're a financial advisor. You have to explain Triple Point Venture VCT to your client in 30 seconds. What would you say?
I'd say Triple Point's VCT is focused at investing in earlier stage businesses than the rest of the market, and that differentiates it. But it invests in more of those companies, and it's the most diversified mature product in the market. That means that you should invest in Triple Point, and you may also look at other VCTs as well. And that diversification in terms of the way that we construct our portfolio means that one year our product might be a leader, another year another VCT's product might be a leader, but you've got meaningful diversification in your overall VCT portfolio. In a way that realistically, we are the only product that offers that proposition of early stage investing in the VCT market overall. And therefore, we are a valuable part of that VCT diversification for any client.
Fascinated to talk to you.
No, thanks, Nick. Always great to
Catch
chat.
up again soon.